Hello, everyone. Today we are going to talk about, today we're going to talk about a lot of things, but right now we are going to talk about a potential way to set up a trade. Now, trades not that they need, there are different styles, but one way to consider it, and I've had really good success with this, is you have a couple of different parts to the trade. You have what we call a setup, what we call a trigger, and then our exit strategy. So we need an exit strategy for a potential loss because all traders take losses. Good traders don't take big losses. So we would want to get out if things start going the wrong way really quickly. And then we have our target for our profit target where we would get out for a profit. So now here we have what could be considered a good setup, right? The setup is like the get ready, get set. It's like if you're at a race. Why is this set up? Well, this indicator down here measures momentum and it indicates that it's oversold. Oversold means something has been really beaten down. Every security has a typical or historical trading range that it spends most of its time in. If it gets pushed aggressively below that, we call that oversold. Now that's important because oversold markets tend to revert back to the average. So do overbought markets, but we're just going to focus on oversold now. Oversold markets revert to the average. So being oversold is going to bring in traders in the market into the market who are going to be looking to buy because they think there's going to be a reversion or they think there's a good chance there is going to be a reversion. So it's oversold. It's also at support. Sometimes levels that are important support or resistance can stay intact for a long time. And you can see up here, this is a resistance level, stayed intact. This is what we call market memory. Things repeat themselves. So back here we had support. Support is a large group of investors that are looking to buy at or close to the same price. And in this case, it's around $70.35. So when a market's going lower, there's not enough demand or buyers to take in all the supply or sellers. So the sellers are forced to offer their shares out at a discount to the market, and that forces the stock or the market into a downtrend. When we get to a support level, there is a large concentration of buy orders or buyers, and they can take in all the supply or all of the sell orders. So that's why markets stop going down when we get to support. And as we can see, we frequently rally off of support. That's because the buyers who created the support with their, or the investors who created the support with their buy orders start to think, oh boy, there's other buyers around here. That's why the price isn't going any lower. So I better increase the price I'm willing to pay because I need to have the highest bid in the market or else the sellers are going to go to someone else. And it becomes like a snowballing effect. All right. So there's a chance it happens here, but it's not a guarantee. Now, a lot of times things that are at support and are oversold continue to go lower. This is why we need what's called a trigger. All right. The setup is the get ready, get set. The trigger is the go. Now I'm going to show us the same stock, but on a much shorter time frame. And this is why a lot of traders lose money, frankly. It's because they just guess, right? Oh, this thing is down big. If it gets to this price, I'm going to buy it. Well, you don't want to guess. You want to let the market tell you what to do. The market can talk to you. And the way it does is by how it reacts when it gets to certain price levels. Now, in this particular case here, we got this support down here around 70.25. Well, what if someone says, you know what, I'm going to buy it. This thing is trending lower. I'm going to buy it if it gets to 68. Well, they're just guessing. It could get to support and reverse. So they might have had the right idea, but because they guessed and they didn't let the market tell them where to put their buy order, they missed out on a profit. So a trigger is one kind of a trigger is a possible reversal. What level would need to be crossed for you to get more conviction that a reversal is underway? Now here, this red line is 72.25. The reason why I picked this out is because it was where we closed yesterday. So there's going to be a lot of investors who bought shares yesterday at this price who now are losing money, and they're going to say, I made a mistake. If I can get out of this thing at break even, I'm going to. So you're going to have these remorseful buyers who bought on the close placing sell orders. Now, one of the important things about trading is to understand it's not about being right. It's about making money. All right. So it's okay if you don't get the absolute bottom. It's okay if you're selling and you don't get the absolute top. If you wait for the trigger, it's not a guarantee, but it's going to stack the odds more in your favor. All right. So if this thing reverses and we get back above this 72.25 level, that could be a potential trigger, but it could still keep going down. So that's why we wait for the reversal to start before we jump in. We give up a point or two in exchange for having more conviction and better profit or better risk reward ratio. So we get above the trigger, that's where you buy. Now, let's pick a potential sell target. I'm going to say right up here. Whoops. I didn't mean to do that. Sorry. All right. So this was a former support level. So this would be my target right up around here. Same thing that was happened down here, right? There are people that bought at this support level who now regret doing so because the price is lower. So we're probably going to have some remorseful buyers who bought here, placing sell orders over here so they can get out at break even. So it's the same concept of here. Where there was support, it could turn into resistance. So that would be a logical place to have your sell target. Now, let's talk about your initial stop out price. Say we get a little bit of a head fake and we get above it and we get triggered and then it reverses. Well, where would you sell it to get out at a small loss? I would say probably right around this resistance level here. There's probably going to be some support there. But basically, if we reverse, we just take a small loss and we move on to something else. So that's our initial stop out. Now, say we start to go higher and it starts to work out our way. There's a lot of different ways that we can have what we call a trailing stop. And they're very important. Some people go by percentages. Some people go by points. In other words, if it reverses by X percent or if it reverses by X points, then we are going to get out. So you're not going to be selling it at the exact top, but it's okay. You could be getting out before the thing completely reverses, and at least this way you keep some of your profit on the table. A potential way to have a trailing stop also, in addition to points or percentages, you could even do a trend line, right? You could say, all right, well, as long as this stock is above this uptrend line, I am going to stay in it. If it crosses the uptrend line, then I'm going to get out. Because when something is going higher, the first thing it needs to do before it starts going lower is to stop going higher. The way charts are recorded is that if something starts to trade sideways, it's going to cross the trend line. And that could be your first signal that it's about to go lower and reverse. So it didn't get to your target, meaning you're not right, but it's about making money. Let the market tell you what to do. And if the market starts to tell you, hey, there's a chance I might start to reverse here, well, that's when you get out. You're still going to take a profit. It's not going to be as good as selling up here, but it's better than missing it. So just remember, one way to look at it at trading is you have a setup, which is your get ready, get set. In this case, it's being oversold and at support. You have your trigger, which is the go, something that needs to happen in order for you to actually place the trade. In this case, it would have been reversion above this, back above this level. Your target for a profit, in this case, it would have been a former support level. And then your stop out strategy. You have your initial stop out just back below here and your trailing stop. As we go higher, you can either use a trend line. You can say if it reverses by X points, if it reverses by X percent, I'm just going to get stopped out and walk away with a profit. It's not as good as getting to my target, but again, it's not about being right. It's about making money. So I hope that helps, folks. Be sure you join our Stock Market Jobber community. Please subscribe to our website. Please give us some likes, and I will talk to you soon.